Okay, so today we're going to review two capital budgeting problems. The first is Under Armour. Under Armour is a U.S. company. It's listed on the New York Stock Exchange with the ticker of UAA. They're a clothing and shoe company. I'm sure everyone's seen their logo. It's the U, and then there's an A above it. So in this example, you were recently hired by Under Armour to help analyze potential investments. Marketing wants to sign Kevin Durant, who is currently under contract with Nike. Okay, so Kevin Durant's Nike contract. First, I have to analyze that. The original contract is 10 years at $30 million per year. He signed at the end of 2014, and it has 6 years remaining. There's a $50 million early termination penalty. Under Armour's potential offer. The total offer is $200 million for 5 years. There's a $100 million signing bonus and then $20 million per year. Plus, they will pay the early termination penalty. All right, and the benefits to Under Armour. So why would Under Armour want to sign an athlete such as Kevin Durant? There has to be a benefit to them. So for Under Armour, there's an estimated increase in sales of $80 million for the first year, $75 million for the second year, $60 million for the third year, $60 million for the fourth year, and another $60 million for the fifth year. All right, so to set this question up, we first need to look at what we're looking for. So assuming that the firm's cost of capital is 8%, should you recommend that Under Armour offers Kevin Durant this deal? This is a typical question we might look at in finance and corporate finance. So let's jump back over to Excel. So here is the Under Armour setup. In year 0, we see the negative $150 million, and we'll go back to see where that came from. So first there is a $100 million signing bonus that Under Armour has to pay, plus the early termination penalty, which is $50 million. So on year 0, we have a cost of $150 million. Next, on year 1, we have, we have the start of the cash flows, which is $80 million. And we see that here in sales, that's where the cash flows are put in. So there's $80 million extra in sales. And then $75 million for the second year, 60 million for the third year, 60, and then 60. Below that, we have the additional costs. So not only will there be a $150 million upfront cost for Kevin Durant, there will also be a cost of $20 million per year paid to Kevin Durant. And then finally, we have the cost of capital here, which is 8%. So let's look at the solution. Should they sign Kevin Durant is the question we're looking for. So first, let's look at the net present value. To calculate this, we've done this in previous questions, so you should be familiar. We will first use the net present value function, and the first value you put in is rate. And remember, if you can't remember what to put in, if you click inside the net present value function or you start typing equals NPV, you'll get this bar right here that tells you what to input. First, you want to put in your rate, which is your cost of capital. Next, you can drag across and put in your values or your cash flows. And then finally, at the end, you have to add back in, or in this case, subtract the initial investment or the initial costs you incur to take on this investment. So the net present value of this investment is $41 million. So we see that's positive, so it looks like a pretty good investment. Next, we want to calculate the IRR. This is pretty simple in Excel. You do equals IRR and then drag across on your values. And we come to our final answer, 18.90%. And here we see that's great as well because it's above our cost of capital. So again, we would invest. Next, we look at the MIRR. This value includes the finance rate and the reinvestment rate. In this case, we just use the cost of capital for each one of these. and the MIRR is 13.36%. Next, we want to calculate the profitability index. This profitability index is the net present value of the future cash flows divided by the absolute value of the initial investment. So here we can see you first put in the rate, which is 8%, then drag across on your future cash flows, divide by, and then use this ABS function, which is the absolute value. So divide your net present value by the absolute value of this initial investment, which is the $150 million. Here we see that the profitability index is 1.2739. Oh, looks like we have an extra A there. All right, finally, we will calculate so first in year 0, we have negative 150 million. That's the first outflow, cash flow that goes out of the firm. Next, in year 1, we receive a $60 million cash flow. So after year 1, we still owe 90 million. On year 2, we receive 55 million. That comes from here, remember. So after year 2, we still owe 35 million. Then finally on year 3, we receive 40 million. And after receiving this 40 million, we will still owe we will now have 5 million in excess of the initial investment. So because of this, we know that the payback period will be between 2 and 3 years. So to calculate this, we first just need to divide the amount we still owe divided by the year 3 cash flow. That tells us approximately at what point in the year we'll reach the point of paying investment in full. We'll see that the fraction of year here is 0.875. So the payback period is 2 whole years, which we see from year 1 to year 2. And then we add in that fraction of a year, 0.875, to come on this, the estimate of 2.875 as our payback period for Under Armour. So looking at that, we can say that yes, Under Armour should invest and they should buy out Kevin Durant's contract and give him a contract with Under Armour.